Hello and welcome to a session of Prime Time. Sorry about this delay. There was a technical snafu that entirely my fault. I really apologize. This should have started 10 minutes back at least. And um we thought we were live, but we were not. That's what happened. It was entirely my fault. So today's session, we are going to be talking about a product launch. At Prime Investor, we have several products, and we have products that cover mutual funds and equities and bonds and deposits and all that stuff. But today's product launch, or the product that we launched about 3-4 days back, is a very different and a unique product. And viewers can correct me if I'm wrong, but I have not seen a product like this in the Indian market so far, in terms of its comprehensiveness and in terms of its coverage and in terms of its raw power that it delivers to the customers, it delivers to the users, right? It's a mutual fund screener tool, and let me bring in Vidya Bala, our head of mutual fund research, to talk to us a little bit more about this tool and walk us through the capabilities of the tool. Let me bring in Vidya. Hello, Vidya.
Hi. Thanks, Srikanth.
I'm
Sorry, guys, again.
sorry about sorry to you too. That it was my fault. I'm sorry again. Uh,
That's okay.
so please go ahead, Vidya. I mean, what was the primary motivation behind creating this mutual fund screener tool?
Right. So at Prime Investor, when we started about 2 years ago, come Jan, we'll be completing 2 years. Our goal was to give retail investors access to simple, unbiased, and quality recommendations across regulated products that are available to retail investors. So as part of that, we started giving recommendations on many products. Mutual fund, obviously is a key among them. We had recommendations, we had portfolios, we had very ready solutions that you could use. But as we engage with you a lot more through the questions you would ask us or through social media, we realized that many of you were discerning investors. After all, you're using a DIY platform, so you wanted to verify some of the conclusions that we were coming with. You wanted to do your own analysis, and for this you would ask us questions on research, and that basically needed us to write reams to you back and explain. So we thought, why not equip you with much of the data that we actually use ourselves, and not in data form but in a more condensed, analyzed form, to make it easy. And by now, many of you would have heard various common terms that we keep telling you. Look at consistency and not point to point. Look at volatility of the fund, look at the quality of paper of a fund, of a debt scheme and all that. Now you will actually be able to do all of this. So for DIY, it's a step, it's a learning. It can be a very sharp learning curve for you to use this tool to come up with your own solutions and understanding also, if you're even new to the mutual fund market. For those who were availing the services of distributors or advisors, many of you wish to verify if some of the recommendations given were right for you. So and you couldn't do it without much data. So for such investors to verify, to do their own kind of checking, and even look at costs, whether you've been given a very competitive fund, or how it looks if it's a distribution, all of those can be done with this simple and yet powerful tool. So the idea essentially is to empower you, if possible, as much as we kind of equip ourselves. So that's the real motto behind this.
Let me just say a couple of words about how this is kind of different from the tools that are out there in the market, right? I mean, there are several places. I mean, viewers can identify the sites themselves where raw data about mutual funds is offered, performance data is provided, and star ratings are provided, and there are sites where rolling returns graphs are provided. But these are all, at some level, first order data. What we have done in the mutual fund screener tool is go 2 or even 3 steps beyond this first order data and provide process data, and then go beyond process data and give a second order process data, and then wrap it all together in the form of a tool, so that you can work on the process data and shortlist funds that meet your own criteria of investment worthy funds, or look at your portfolio and see if they actually meet your criteria of investment worthiness. This kind of putting it all together and wrapping it in a tool is, I don't think, available anywhere in the Indian market for mutual funds. I mean, similar tools are available for stocks with a lot of data and stuff like that, but for mutual funds, I think this is the first one of a kind tool that we're offering, the mutual fund screener tool, the Prime MF screener tool, available right now on beta on our website. You can go to our website right now and access it from the from the navigation bar on top. It's just called Prime MF Screener, and it'll be available for free during this beta period until hopefully the end of next week. So let's get going. Vidya, you want to show a simple example and get us started?
Yes, Srikanth, can you please share the screen for me?
Yes, please. There you go. I can see.
Right. Right. So this is the page that you will see when you get into our screener. This is the default page with, our own ratings, of course, and the inception date, which is a very important criteria must be a very important criteria for your filtering funds, and AUM size. And then you can, go ahead. I will explain more about what the top these three are, but you can just go and kind of choose your own set of category and add filters, just to give you a sense of what sort of filters that we have here. I'm adding these, so you will have these columns. You can sort them. Very importantly, you can save your screener so that you can rerun them whenever market turns, or you can export and put them in an Excel and start working on it. You can look at category averages. I will actually explain to you how those can be done also as we go through, but this is the look and feel. If some of you have used our stock screeners, it's pretty familiar. It's the UX is pretty much the same, except that we have our own ratings, etc., here put in, and the filters obviously are a little differentiated. So you will see performance, portfolio filters, sector exposure. You will see expense ratio. All of these I'll take you through quickly a bit later. But this is the look and feel, just for you to get an idea.
This looks very, elaborate. I mean, how is the from top down perspective? What is the first thing that somebody should know when they open this page and look at it? What is the first thing that they should,
Right.
Figure out first?
Right. So as you can see, you have a default page and you can add filters, and those are the filters, the parameters that you will use to kind of, filter and screen your stocks. But before all that, the top level is very important, because at PrimeInvestor, we place emphasis on consistency, and we place emphasis on not point to point but rolling returns. All our metrics, and that's the way it is when metrics are calculated, are based on rolling returns. Whether it's your Sharpe or your standard deviation or your average rolling or your outperformance, all of those are rolling returns. So the very important thing here is, one, obviously you choose the category, and here again we have not put the multiple SEBI categories. We just made it simple for you. We have put those categories where you can compare common data sets, right? So equity, you can compare common data sets. You can't compare equity and debt, because the parameters that you need to use for those are quite different. So debt is separate. Those that use derivatives, categories that use derivatives are separate. For example, you have arbitrage, equity savings, balanced advantage, dynamic asset. All of these use arbitrage. Then you have your hybrid conservative, you have your hybrid others, which includes aggressive, and your solution oriented funds and all those. You have gold, and these kind of categories that you will see as you go in. You can choose multiple subcategories. Very importantly, you have to choose your rolling return period. When I say rolling return period, it is basically whether you want 1 year return, or you have shorter periods also, 3-year return or 5-year return. We have not taken 7 and 10, while many of you asked us, because there's hardly any data to roll. So when I say a 7-year rolling return, a fund needs to have, to give one instance of return, it needs to have a 7-year period, right? If it needs at least 100 instances, imagine how, you need to date back. So if it needs at least 300 instances, you have to go back by 8 years, 9 years, 10 years, and so on, which is very hard, right? So which is very hard in the Indian context because our funds don't have that much of a record. So we have been very practical. We don't want you to give a screener where it just throws you two funds, the oldest among them, your HDFC or ABSL and not the others. You're given funds that you can compare. Typically, for when you want to see shorter duration funds, you can use shorter periods like your liquid and your ultra short. You can look at 1 month, 6 month. For equity, typically 3 and 5, but no harm in looking at 1 year also to know how the trends are changing, right? But you can choose only one at a time for the simple reason all of these parameters will run based on what you choose there. So that's the top level. You fix your category or subcategory. If you don't have any specific subcategories, you want the entire equity, you can do so, and then you can choose your rolling return period. Once you do this, for example, I choose a 3-year rolling return period here, and I decide to choose, say, equity and say large cap, right? Filters. Now, these filters again, depending on which category we are in, can vary. I have performance filters here. I have portfolio filters. In equity, for example, it will give me, your exposure to large cap, mid cap, small cap. These are very important because it actually tells you whether a fund is taking a higher risk or a lower risk to deliver the kind of returns it does. Right? Portfolio turnover is a very key data. You will see in some of the funds that have generated very high returns. I can name them like some of the funds from Quant House. You will see the kind of portfolio turnover, the churn that these funds have seen. Cash holding is a very important factor, right? So these are some of the portfolio things. Key sectors. Many of you ask us, I want funds with lower banking exposure because I already have enough banking, or I want funds with, pharma and ITS. So this essentially will help you screen all of that. So it will tell you the proportion of holding in some of the key sectors that influence a fund's behavior, which typically are higher holding in any portfolio, higher weights in the market. And the last one is very useful because especially if you are one, it will tell you whether your fund is low cost or high cost. You can use the expense ratio and check for yourself, but it will also give you the difference in these expense ratios. For example, here the difference, right? You can see that Navi large cap, for instance, the direct is 0.3 and the regular is 2.5, and the differential is extremely high, especially if you're sold these products through a distributor. At one shot, you will know whether you are sold a high expense product. Even without that, you can look at your expense ratio also. You can add this as part of your other filters and look at performance filters along with your expense ratio filters, right? So this is the broad. So if I take debt, for instance, I will have slightly different. The list of parameters here in debt will be somewhat different, right? And portfolio is definitely entirely different. In portfolio, we have some of the key things that you need to know on YTM, maturity, rating in percentage holding in rated instruments, and the nature of instruments. For example, you want to know a fund which has very high exposure to sovereign debt, which is government securities, which is not gilt. Even outside of gilt, fund can hold sovereign debt. You will get to know because you want safety or things like that. You want funds with lower average maturity, you'll be able to use this to filter, right? So not to worry, we will this might sound a lot of data thrown at you at a time. We will over a course of several months take you through both through our write-ups or through our webinars on how to effectively use this to come out with optimized output. Your output should not give you wrong interpretations, right? So we are going to help you do that, but please familiarize yourself, play around with these, and you will understand what we have. In fact, just to kind of give this a quick thing on how to use, right? You have the guide to filters. It will even explain what each of those filters are, and very importantly, we have two others. Can I just take them through this as well, Srikanth, or
Can you just hold on that for a second,
yeah,
Vidya?
yeah.
We have a basic question. Babri Finserv says, my screen shows only inception date and AUM, but they will be. Can you just show how to add filter? Just a
Yeah.
very basic
Yeah,
step. Yeah.
so by default, so on default, let me go to the default screen. This is your default screen, right? If you take equity, for instance, you'll have prime ratings, inception date, AUM. Add filters, right? When you go to add filters, you have all the performance metrics specific to the category you have chosen. And in some cases, even to the subcategory. For example, index funds. There's no question of index fund outperforming the benchmark. It's about tracking error. So we would have tracking error in index funds, right? So some variation in the metrics will be there. Portfolio will change for equity, will change for debt, will change for those with derivative instruments and so on. Key sectors available in all equity oriented, categories, and expense ratio. Now you can use all of these at a time. You can go on adding performance metrics. You can go to portfolio, then you
Can
can
you
add these.
hold there one
Yeah.
second, Vidya? So as you can see now, the person who asked the question, the filters that Vidya added in the pop-up are going to the left. Can you come out of the pop-up add
Yes,
filters?
yes. As you can
You will
see, they
see,
have been added here.
and to the on the left as well, where you can
Yes,
do the actual filter.
exactly. So the filtering happens here. So there are two ways you can filter, right? Some of us, like we are very comfortable with Excel. The moment I take data, I download it and I work on it. But if you want to reduce your filter size here, you can go. For example, you can go and give, this one or two comes because they may be derivatives. You can go funds, go and choose funds with over 50%, you know, uh, exposure to large cap, right? Or 50 to 80% exposure to large cap, and it will reduce your results. So you could play around with each of this. Each of this, as I add, they not only come on as an output, they also appear as a filter that you can use. In fact, if you are new and you want to reduce, you can actually stick to the higher rated funds and also see within that how they fare, right? For example, you may want to just remove the unrated funds and keep all the others, right? So you don't want so here, for example, I only chosen 3 rating and above, right? That reduced my 315 funds to about 77 funds here. So you could play around. You could give criteria on inception, or if you're in debt, for example, you might want to very importantly give criteria on AUM. You don't want 50 crore and 100 crore funds in a liquid or ultra short category. You need to have higher AUM funds. These are also things that we will explain to you as we go, over a period of time. Write about it, what filters are appropriate, what are not, etc. But just play around and familiarize yourself. So this is how it works.
Okay. Sanjay Chatterjee has a question. I think we'll put a pin on it and come back later because it doesn't directly relate to the our MF screener tool. Vidya, so you gave us an overview of all the features that are there. Can we dive a little deeper and tell people about some basic screens that we have put together for them to get started?
Sure. So, this is the filters that you add yourself. This is what we saw. But if you are not getting a hang of what sort of filters to mix and match, we have some very simple screens. They are not really outputs. They are not condensing your data or anything. They are just giving you an idea of what you can mix and match. For example, I'm going to take low volatile equity funds. It's going to take funds across equity categories where their fluctuation is low, right? So what have I taken to kind of check at fluctuation? You will see that it is automatically here sorted by standard deviation, right? So the lower ones, because I have a 1 year return, the standard deviation seems high. You can change it to 3 year returns and it will kind of the deviation is less, but you will see those with the least standard deviation and the minimum return. Just for you to know what is their capacity, we have the maximum rolling return, we have the average return, and so on. Now this can just be a starting point for you. You already know, okay, I've got, now if I have funds sorted by low volatility, I'm probably going to look at the top level, or I am going to give a range of standard deviation. For example, I just want to stick to those between 18 and 25. Or if we are not comfortable with that, download this data, take the average, give your average as a cutoff. Then I want only those which are lower than this average. So I've reduced it here kind of. Then you can add something like, you want to see the Sharpe because it's a risk adjusted return. You also want to get an idea of point to point returns because you can't be entirely close to the idea. So I'm adding. Now you can also sort. So you can either download or you can also sort. For example, this fund which has the least standard deviation in this lot, which is Axis Blue Chip, also has a maybe it's not the least Sharpe, but I mean, sorry, it needs to have the highest Sharpe. So if you take by Sharp, it actually comes second, which is pretty good, right? So you have a fund which is really low volatile and produces superior risk adjusted returns. And you could go by the you could look at the minimum returns, whether it falls less and so on and so forth. So that's up to you. So while I say this, I also want you to be cognizant of, as you see this, please take note of the inception date. What we have tried to do here is sometimes not give you so we have stuck to, if you see here, all the funds are rated. The reason why we have not taken the unrated funds here is they would have not passed the minimum criteria needed to give you decent data on rolling return. After all, your standard deviation or your Sharp or your outperformance is on rolling return. If I have just 5 instances or 10 instances or 1 month of rolling returns, I'm not going to do much, right? So we have tried to condense it to only those that have certain instances. We have given details of those here. I would urge you to read all of these, equip yourself on how many minimum instances we typically take, before we, actually give you this data. So that's the basic screen for you. I just showed you one combination. There are other combinations. We can add any number here, but the idea here is for you to know, if you go through these, you will know what metrics that you can mix and match. It will not condense. You have to do your own condensing by, giving filters, etc. But it will give you a good idea of what to mix. The next, yeah.
Sorry to interrupt. I just want to make a quick point there. The basic screeners, with its ability to, by putting a label, on it, saying that these are. Can you open the basic screener for a second, please?
It's here. Yeah, one
No,
second.
no, no. Can you
Yeah.
click on that? Say when you say low volatile equity funds or emergency very short term funds, what are the criteria that we look for? What I'm trying to say is it's a very educational tool also. When you
Yeah,
say that emergency very short
absolutely.
term funds, these are the criteria that you should look for when you are considering short-term debt fund investments or for emergency funds. That's the kind of there's a lot of learning, not just
Absolutely.
a tool that you can use, but you can learn from this tool as well. And that's one of the principal reasons that we put those basic screeners out there, so that you will get to understand how things happen behind the screens
Right,
at Prime
right.
Investor.
For example, in low volatile, when I say just low volatile, it doesn't make sense if the fund is not able to deliver, right? Which is why we put the average rolling returns, right?
Yeah.
We put the maximum return. So you get an idea. And you can add to it. You can add Sharp to it. So, like I told you, this fund scores well on, Sharp and standard deviation, etc. So the sometimes looking at a metric in isolation will not help you. Not sometimes, it never does. It never helps you make decisions. So metrics have to be looked at together. And that's not something that you can do by looking at a fund detail card or a fund fact sheet card or anywhere on any website, because they are in isolation. So when you look at them, for example, you look at the category average and you decide this fund is above category average. That gives you a better idea of where this fund is, rather than just looking at our ratings. You actually look at the numbers. Yeah.
Yeah. So this is a tool that you can use to select funds. Just you can use it as a playground to tool around and see what kind of funds are where and all that stuff. It's an educational tool. It serves multiple purposes. Let me take a very quick question, Vidya. Saurav Suman wants to know how often the data gets refreshed. The data gets refreshed every day. However, some data doesn't. Like portfolio data. The mutual fund houses provide the portfolio data only once a month, so that will change only once a month. But performance data gets refreshed on a daily basis in the morning. So you might see a 1 day lag in the performance data for some funds, but that is because of the speed at which data arrives to our portal. So
Yeah.
to answer your question, data gets refreshed every day. There are a couple of other questions. We can take that, but you want to quickly cover advanced screens and then we can take a few questions.
Yes, I'm just going to kind of, like taking a class, just to, again, kind of reiterate. So
Yeah, please.
the three things at the top matter to you in every filtering. We spoke about filters. You can use play with filters. You can add filters. You can modify their ranges, etc. This is if you know what to look for, right? If you don't, basic screens will give you an idea. So we just gave a few here so that it'll, across different categories, so you get a hang of it, what we are looking for. Advanced screens are somewhat output based. So in basic screens, we're not trying to give you an output. Advanced screens actually condense or filter the funds using certain criteria, and come up with a kind of a output for you. Let's look for example. So we have about 12 of them here across categories. We can always add more when we will strive to, but the idea is for you to also get, these are very common things. For example, people might want high quality debt funds, people might want debt funds for a 3-year time frame, you want very consistent funds, you want aggressive equity funds. So we have just put need based things here, but it could very well be beyond that as well. For example, many of you ask us about equity funds investing overseas, that hold international stocks, right? Outside of international funds. So you have those. At one shot, you can see even local funds which have some exposure to international equity, like your Parag Parikh does. So let me just quickly take something like consistent all cap funds. When I say all cap, these are categories that can invest across. So that's your large and mid, your multi cap, your focused, contra, your flexi cap. All of these can invest across. So here, if you look at the output, because we said consistent, it will automatically first throw the proportion of outperformance over benchmark over a 3-year period here, because we want some amount of period, not 1 year. So you would see these funds have actually beaten their benchmark 100% of the times on a rolling 3-year return basis. But so whether their returns is also high or is it just being consistent, we have the average returns here. Then you have the average returns of the category, right? So that you can compare. Now these are so the important thing is, as you see, you are seeing across different SEBI categories, so you will see different average returns here. So it is best that you compare each with their own averages. You can add filters here again. You can, for example, use sharp and add, and it will use the same 3-year return to give you the sharp. Now if you want to change the period, you want to use 1 year, etc., then you will have to refresh, or you have to basically use a new screen, because these are predefined screens that help you give an output for the said objective that we have. We want to give you consistent funds. I have just used few metrics. For example, within this, how can you improvise it? You may want to get funds that are for example high on your mid cap, right? So I have added your mid cap and small cap here, and I have tried to look at these. So you will have large and mid cap funds coming here at the top, because they have a higher proportion. Now these, you can then again look at outperformance and also see which among them are good, if you're looking for more aggressive funds within that, or if you're looking for more conservative funds, for example, look at the proportion of large cap, right? So you have your the regular categories, your focused, flexi, some of those have higher large cap. Here you can look at the proportion of outperformance. Is it 100, is it 96, 92? You can give ranges here. Like I said, the proportion of outperformance has to be at least 60-70%, for a fund to say it bet its benchmark reasonably, right? So you could use those. So or you could download and look at the category average and use whatever is above the category average to filter, and those with higher large cap or those with higher mid cap and so on. So that's another way. And to aid you, obviously, you always have prime ratings. That's another way for you to know if you're not doing something wrong. Unlikely, because it's pretty much that we add some more data and weights to data to arrive at our own ratings, but a majority of the data you will find somewhere here, right? So we will be using those for our ratings. So that's what advanced screen basically does for you. I'm just looking at debt funds for a 3-year time frame. I'm using a criteria. It's between 2 to 3 years. You can see the average maturity would not have crossed, a 3 years, because you're saying it's these are debt funds suitable with a 2 to 3 year time frame. I don't want to cross 3 years because it will become more volatile. I've looked at the average rolling returns. What is it for the category? For example, this fund, the category average is 7.85 over a 3-year period, and this fund has an average of 8.65. It outperforms its category 99% of the times, right? So these are the kind of things. Again, be cognizant of the category itself. Be cognizant. You can add portfolio here, for example. You want to see how much of it is below a AA plus, right? So that will kind of help you. Here it is below AA plus. Now you will see Baroda credit risk beating category 100% of the times, but it has a 44%. It's a credit risk fund. It has 44% in instruments below AA. So that's a kind of an alert for you, right? So I have given you a combination with portfolio and returns and maturity and kind of maturity. So you know how to mix. Again, even in advanced screens, you can actually learn how to mix. But by way of our doing this, we have condensed it already for you because the maturity at least is in a smaller range. We are not given you the 500 or odd debt funds. We have condensed it to just 35 or so, right? So this is what advanced screens will do. You have very interesting, ideas here. You can go through them. If you have more ideas, you can simply go and add filters and try them out, right? It's not just idea, it's your requirement. I want low risk debt fund for a period of 2 years, right? Then you can simply go and choose a fund whose average maturity is, not greater than 2.5 at most. And then you can look at the quality of paper there. You can look at their average returns versus the category. In all this, in debt category makes more sense. One, benchmark data is not available, seldom, because they are paid and used only by AMCs. The second thing is benchmark and debt funds are quite way away because the benchmark is a more theoretical thing, unlike equity benchmarks, and there is an expense ratio which makes a huge difference, right? Here again, with debt, please don't forget you can add expense ratio. Expense ratio matters a lot in debt, right? So these are things which will, again, I will take you through those as days and months go by. Both Bhavana and I will definitely do this for you, but you should start thinking on those lines. What should I look for in a fund? The performance, the quality, the cost, right? Pretty much that. And within that, what is it that you want? What is it that fits your portfolio? So that's the way you go about, approaching the filters.
Okay.
Yes.
Thanks, Vidya. Let me take a couple of questions. First, thanks to Captain Vittal, Naveen Mandava, and Saurav Suman for very positive feedback. We like constructive feedback, but we love positive feedback also. We can use all the encouragement. Thank you, really appreciate that. So to answer a couple of questions, um, Balaji wants to know, I understand presently it's open for everyone. Once it gets to growth plan, can we have a call for prime recommendation also? It's a good thought. Our buy sell hold recommendation. That is something that we can definitely consider adding. We'll note that down. And Saurabh wants to know, can we save some of our custom criteria filters for reference and use it in future? We can, right? Saved screens. We
Right.
can save a screen, right?
Here. So you
Yeah.
can either download the data, which means you download what is there today. But if you save a screen, you can name your screen. You can even give it some description and you save it. For example, I'm just going to, say 3-year debt fund. And, I'm just going to say for whatever, for my portfolio, and I'm going to save it here, right? So I can always go to saved screens and you will find it here. If you have no longer use for it, you can delete it, right? So you don't have to run criteria time and again. If you have decided, hey, this is my set of filters, I'm going to keep running and checking periodically, say quarterly or whatever, you have it set. Or if you want to download and use it every time because you want to work on Excel, you could do that too.
Okay, there is a broad question from earlier on, Vidya, from Sanjay Chatterjee. I would like to know how rating profile is done. What are the factors to consider? If you can give a brief answer, I think we have a separate article about it. We can go to that article and find out. But if you can give a
Yeah.
few lines, yeah.
Yeah, so we have a very detailed one on what we do in our ratings, but our rating criteria takes into account. So our rating criteria varies across different categories and also across different sometimes subcategories too, because the the risk profile of different categories warrants us to look at certain specific parameters. Just to give you an example, for a large cap fund, for example, containing downside, maybe paramount. You can't be a large cap fund and fall like 9 pence. So we will look at those, right? If you are a mid cap fund, your ability to deliver on the higher side also matters, right? So we will look for those. So we have many of the factors that we said here. Consistency is a very big factor. We look at proportion of outperformance over category, over benchmark, or rolling average returns, standard deviation, Sharpe. When it comes to index, things like tracking error. Then we also do a few, like I said, next level of analysis in terms of upside capture, downside capture. What is it able to do in an up market? What is it able to do in a down market? Is it better than the benchmark? And then some of these portfolio things and some of the, for example, in debt, for example, the quality of papers matters, the proportion of holding in different papers matters. Those, all of those are taken. So you would probably find 60-70% or 70% or more of the data that we use right away here. The rest is further processed. Basically it's a further DIY research that one needs to do. But with this data, you could, the reason why we have given this data is you could arrive at very similar conclusions as our ratings with your own, this set of data. And, sorry. Um, so we on our ratings, so there is performance, there is portfolio metrics. The very important differentiation that we do is we weight those factors and we arrive at a score, right? So when it comes to ratings, our buy hold sell is the next level. There are qualitative factors that we have to manually screen and look for. That is why, once Bhavna had explained to you through an article on why our rating should not be construed as a recommendation to buy, hold, or sell, because you do look at a lot of factors that quantitatively you may not. For example, a fund that has really low on percentage of outperformance may actually be picking up and improving its performance. Its 3 year might look bad, but maybe in its 1 year rolling, it's picking up, right? So these are factors we will look at, to arrive at our own conclusions. That's the extra bit, that we do. But otherwise, taking qualitative, performance factors, portfolio factors, weighting them, arriving, standardizing them, arriving at a score, and ranking them on a bell curve, basically, is pretty much what the ratings will do for you.
Um, so the other question is about Sortino ratio. Uh, we have Sharp in the tool. Do we need Sortino ratio then? What are your thoughts?
So the thing is, there are multiple ratios that you can use, right, to look at performance of funds. There is Traynor, there is information ratio, there is Sortino, and then for volatility, you could look at beta, you could look at standard deviation, and all of those. So we used giving multiple ratios sometimes just can give you very divergent directions, right? For us, we may dig deeper and understand why the divergence exists, but for you looking at processed data, you'll wonder, should I go by Sharp or should I go by Traynor, or should I go by information ratio? So we thought we'd stick to the very traditional, largely well working ratio, which is the Sharp, which is nothing but your excess returns over a risk free. You could use an index. We just used risk free by using Sharp, divided by its volatility, right? The things that makes this tool superior, even though you may not have a Traynor or a Sortino, is that you have other metrics. You have your proportion of outperformance, you have your average rolling return and not a single point return, you have your standard deviation, you have the worst performance, you have the best performance, and so on, which will kind of give you a holistic view of the performance per se. Instead of giving you 4-5 ratios, we thought we'll give you one key ratio of risk adjusted performance and use breakups of these to arrive at conclusion. And you will largely see in many cases, when I was showing you data, the proportion of outperformance is often high when the Sharp is also high, right? So the divergence will not confuse, there won't be that many divergence for you to confuse. So I would say, use one or two key metrics, stick to it, and so that your results are not, every time you don't have to look at, they're not divergent one, and you don't have to interpret them differently every time. So that's the idea behind sticking to one simple ratio that easy to understand, and supplementing it with multiple other metrics that can be called as breaking up of this.
A follow-up to your response, Vidya, is that Sortino provides downside protection. Is there any other way to gauge downside protection from a tool?
Yeah, so largely what we have seen is that both in terms of, so your risk, your Sharp basically is a risk-adjusted return. So the reward is known for the risk. We have given you the standard deviation. We have given you the worst performance over average rolling return. Over a rolling return period. So a fund that really falls badly is immediately shown to you, right? If you take some of the high performing funds, you will see the standard deviation will be high, the minimum returns will have high negative returns and so on. So it's a kind of a proxy, a very clear proxy, so you don't have to worry that you missed something here.
Okay. Um, Going to Ganesh and Singaram, is it possible to have a provision for folio numbers for each MF and tools for getting daily alerts and kind of alerts? So what you're asking for is obviously slightly different from, very different from the MF screener tool. But what you're asking for is more like a portfolio tracking tool, which is something that at Prime Investor we are considering. I don't want to make tall promises, but that is something that is tentatively on our roadmap. Please look forward to hearing more about that. And looking at more questions. Um, and Balaji NS wants to know, is there any way to get an alert on AUM churn? Alerts, again, personalization of our research platform in terms of these save filters and all that is one form of personalization where you can save your own kind of screens and things like that. But personalizing data movement for individual mutual funds and having research level alerts, that is also something that we're very keen on doing. But that is a significant enterprise, significant effort to get done. We will get there. We are a work in progress, not just this tool, but as a platform, we are still a work in progress. So we want to make our platform very personalized, very customized to each customer and investor. So please hang in there, and we'll get there. There is a question about balanced advantage and dynamic asset allocation category, why they are separate. Um,
Yeah.
uh, Vidya, you want to take that?
Yeah, so although SEBI says balanced advantage and dynamic asset allocation, funds need to fit themselves or classify themselves into one of these, right? So very strangely, you will, for example, you will find. Let me just go to here, and I will choose balanced advantage and dynamic asset allocation. And a fund, for example, called Edelweiss Balanced Advantage is actually classified as dynamic asset allocation, right? So the data that we receive, these are feeds, right? Data feeds have to necessarily give it as balanced advantage or dynamic asset allocation. But the good thing with our filter is we allow you to choose multiple subcategories. So you could compare them both together. So technically, there is no problem for you to put them together. You should put them together and compare. But SEBI allocation and classifying themselves in one of these has meant that the feed that we receive is separate. I'm right, right, Srikanth, on
Yeah,
the
you are
data part.
absolutely right. It is a data feed issue. We cannot tinker with the data feed, otherwise we lose other we'll create other data consistency issues in our processing. Um, Gopinath wants to know, is there a portfolio optimizer tool in the website? Please, we have a portfolio review tool, a mutual fund portfolio review tool right now. You are probably
Right.
familiar with it. It
Yeah.
gives ratings and buy sell hold recommendation along with rationale for every fund in your portfolio. But that is just the beginning of what we are planning to do with a portfolio review function. Definitely not the end. It is in our roadmap to do a more comprehensive portfolio review tool. And a portfolio optimizer is taking that even further, and that is something that's actually a good phrase. Portfolio optimizer. We'll definitely consider that. Thanks for the feedback. Um, yeah, watch list and portfolio tracker in future. Definitely. Hello, Apurba. Apurba definitely will do that. And there are some two suggestions regarding the usability of the tool. We'll definitely take them into consideration and talk to our tech team about how we can make it better. And I think I've covered the questions that are out there right now. Any further thoughts? Will you show tracking error for passive funds? You want to walk through that a little bit, Vidya?
Sure. So there are index funds here. and you can go here and add your tracking error, right?
There you
But
go.
I just want you to be cognizant again, much as we have done our due diligence to reduce wrong, I mean, interpretation of data, you might still have, that's which is why I keep insisting that you please look at the inception date, right? A fund that has lesser tracker, for example, I may have a cutoff say of 2 years here, and have a fund which minimum 2 years I might show you a tracking error, but you need to be aware that a fund with limited, data, depending on the market at which it was launched, may sometimes show data. For example, in many of these newer funds, we would not even have showed you the data, like the October Edelweiss Nifty Index. We don't want you to give, because its tracking error might seem extremely low that you might be forced to conclude it's the best fund. It's not the case. In fact, for many other data we have done that. It's true of tracking error too. So when we give blank, please understand that, in rare cases we won't have the index, like, MSCI, there is no availability of this index in rupee terms, so I can't just, we can't possibly take it. But in many other cases, just wait it out to gather some period of rolling return, so that your interpretation does not go wrong. It's true of tracking error, it's true of all other metrics also, right, where the rolling instances are less. Like I said earlier, we have mentioned about it on the rolling instances that we need, and so stick to funds that have data. Don't, if you don't have data, just wait it out for the fund to have some record before we can go for it.
Okay. Bhavri also wants to know if you can provide portfolio overlapping tools separately. That's again, there are so many things that you can do, and that is also on our roadmap. Please,
Mm.
I don't want to keep repeating that, but we have product roadmap is pretty long. I'll just say that. Atul Kandelwal wants to know. I think we addressed this question just a little bit back, but so you might want to give a very brief answer, Vidya.
Mhm.
How can we assess downside risk or protection through the screener?
Right. So, like I said, one, your sharp basically takes care of standard deviation. You could look again at standard deviation separately, and you could look at the minimum returns. Again, this minimum returns is not point to point, right? Because it's the worst performing returns that the fund could have had. All of these three put together will kind of give you a sense of volatility in the fund, right? There's a separate thing called downside capture, which we have not provided, I must admit. It requires a different level of calculation, because you need to take only those periods where the market has fallen, if you have the data, and you take your fund returns over that period, and then you see whether the fund has captured. But what we can definitely conclude is that it's not going to give you very divergent results from looking at sharp plus standard deviation plus the minimum returns. So you could use this as a proxy safely.
Okay. Naveen has a suggestion would be to have a graph that compares rolling returns across funds. We
Hmm.
definitely already have that, Naveen. Please check
Yeah,
out
so
our mutual
yeah,
fund.
so for many of you who are not, may not even be aware where all this is buried, if our
There you go.
website is too understated. First, on tools and calculators, you have MF Screener. Obviously, you have your review tool and all that. Then you have your rolling returns calculator. This is very much a graph, right? You could add a couple of funds here, and you would have not just the graph. It gives you a very quick snapshot of some of the data we actually provide in our screener too. So your average, maximum, minimum, negative proportion. In fact, there is a return distribution. What proportion of times has the fund delivered between 10 and 20%? You get to know whether it's an aggressive delivering fund and all that, right? So this is a very useful tool. And if you don't want to look at graphs to interpret data, we have another tool here called rolling returns versus category, right? So in this, essentially, somebody wanted downside. I must have told this to you even earlier. You can use this. This is a tool available for everybody. Your essentials and growth. So you could look at proportion of losses. This again is a very good proxy. Even if you don't do downside capture, this will tell you what proportion of time the fund has had losses. So the one with lower proportion is a better one. So these two tools, please, I would urge all of you, and for those of you who would be in essentials plan, this and the rolling returns calculator and the expense ratio, direct versus regular, all of these are extremely useful tools and can help you meet this more than almost halfway or so. The only thing that you don't, which is valuable, is the portfolio related data and few other nuanced calculations we have in our MF screener. And of course, MF screener is in a more usable form, in the sense ready to analyze kind of a form. Yeah.
Thanks. Balaji and us, thanks for your usability suggestion. We'll definitely, there have been quite a few suggestions in this chat boxes. We'll
Thanks.
definitely take them into consideration. Apurba wants to know what's wrong with 2-year return, what's wrong with 4-year return, what's wrong with one and
We
a half
could
year.
have any number of, we could have 1.5, 2.5, 3.5.
Yeah, I
But
mean,
typically,
this is just industry standard. I mean, we
yeah,
didn't pick
it's
it
just
up.
industry standard. And end of the day, see, your 2-year, 1 year, 3 year, if you take longer periods, they just end of the day converge. So the rolling period we use for one, and lower than that is 3. I mean, the period from 2 period, and for the others, it's like 5. So for a 3-year return, for a 5-year rolling return, you would have 10 years of data at least, right? So we have sufficient data to kind of cover interpretations. Between 1 and 3, you're not going to significantly. So a shorter term trend can be seen in one for equity, right? So if you actually go and look at your large cap funds, it will be crazy now, because the last 1 year has been crazy. Results will be very different with 3-year returns. So consistency is about doing things again and again across market phases, right? So a 3 idea is it can capture at least 2 market phases, a 5 even more, which is why, but one is important because emerging trends can be captured in one. So that's the idea of having multiple. There's no hard and fast rule really. It can be anything, but the standards that our people typically look for, we've used it.
Okay. So any closing thoughts, Vidya?
Right. So probably, yeah. So like I said, we will be taking you through this tool over several months, over webinars. Many of our articles can be about helping you use this. At Prime Investor, we don't think we own data or we are the masters of research. We think research should be democratized, and we think, from especially after our engagement with you in the past 2 years, we think many of you or most of you are interested, are capable of doing this with just some amount of time and the right amount of data. The problem today is either you have no data or you are thrown excessive data. Excessive data is a problem unless you know how to handle it, right? So we are trying to walk the middle path here. So when many of you ask these questions about why not this, why not this, there's no harm. I can easily give you. It's our tech folks are going to code it and it's going to be out there. But how do you interpret, right? So that's the middle path that we are trying to take. But we obviously we will improvise, and as you start using it, I'm sure we will learn from you, and that's something that we will look forward to. And the other thing that I want you to also be aware is all of this. One, for whatever reason, the market does not put out these kind of data to investors. They either throw you NAV data to make your own conclusions, or they make it so hard for you to consume data in a usable form. So that's a space we are trying to fill for you, to empower you, and not with any other motive. And this does take a lot of time and resources for us, both in terms of giving all the data is easy. Condensing and deciding what to give, how to give, and for what purpose, when you use it, what problem does it solve for you, is it's a lot more harder. And for this purpose, we have made this a premium product. So if you are entrant into mutual funds, you have ready solutions and essentials. You can go use it. You can buy it. I mean, look at our portfolios, go buy them. You can look at our recommendations, go buy them. But this we consider as a next step for people who want to use it. And therefore this is part of our this will be part of our growth plan, the more premium one, both for the nature of the product itself, and both from a perspective of our own business effort towards giving you this product. So because I know one or two of you may have had that question on why it is out there. the essentials by itself is complete with recommendations, with tools, and we will constantly thrive to improvise what we have out there. But the more nuanced one, people who want to grow in terms not just their wealth but their own capability to, come up with, their solutions. This is the offering that we have, and we'll have more of such in the coming year. I'm sure you will. We will. Shrikant, do you want to, so in our mail tomorrow or so, people will get a clear idea of what are those upcoming products, right?
Yeah, that'll go to a section of our
Right.
customers. But yeah, I mean, basically, uh, we are trying very hard. Okay, we are trying very hard to come up with innovative products, not just because they're innovative and unique, but it'll be useful. It'll empower you. It'll educate you, and it'll really enrich you in terms of your portfolio value and your investments.
And
That's
in all this, we,
in the
we
day.
want to we want to strive to be independent in all this, right? So that's the driving force. One, we want
Exactly.
to stay independent. We want to ensure our loyalty remains towards our customers, and not towards
So
anything else, right? So that, I mean, that's not an easy path, but we will do our best. And I'm sure you guys have been supportive on this, and I'm sure you will continue to. And your feedback is always taken seriously. The fact that we may or may not be able to implement them does not mean that it's not recognized. We recognize and appreciate the effort and time that you take to come up with your feedback. I mean, we had our beta out and we had so many people giving us,
yeah.
you write to us to give us feedback. We really appreciate it.
We've had like really good amount of feedback, both positive and constructive, for this tool, and we are very very appreciative and thank you for both. And like I always say, we try very hard and we try to do the right things for the investors, and we count as always on your support to help us grow. So please share the word, please spread the word, and share the tool and the word about Prime Investor with your friends and colleagues. And I'll see you. There are a couple of other questions about insurance and small case. Don't worry, they're all on their way. So
Yeah.
we'll definitely fulfill all your expectations, requirements, and aspirations when it comes to investing and personal finance. Thank you very much. Thanks for joining us, and hope to see you next time. Thank you.
Thank you.
Thank you.